like you aren't, but you do quite a nice job with it. So good morning, gentlemen.
Kara.
Good morning, Kara.
Always,
Yes. Good morning. Good to see you.
all right. Always forget to take the transcription off. But anyway, good morning to all and welcome. Thank every one of y'all for being on this morning. It's always a pleasure to get up early and have you guys on every month. And we greatly appreciate your effort and all that you do. We don't have a guest commodity speaker this morning, so we're just going to jump in and but we all are thankful for all the things that they do for us: the Cotton Board, the Corn Board, or the Texas Corn Producers Board, and the Texas Grain Sorghum Producers Board, helping us out on a regular basis. But we couldn't get one of them this month. But we're going ahead with a program, and we're going to start off with Dr. Robinson. He's going to give us a little update on cotton, and I'll turn it over to you.
Very good. Thank you. I can wake up. There we go. So, we'll get the cotton market out of the way first and lift everybody's mood back to a holiday spirit. This is the last half dozen years of cotton futures prices, nearby futures compilation. And I put it up to show a number of things. If you look at the beginning back on this chart on the left side, back in 2019, we had prices hovering between 60 and 80 cents. Then a whole lot has happened in between, a lot of upward volatility, a lot of ups and downs. And where we are now on the other side in 2020, well, really since 2024, we've been back in an even tighter low range, in a little bit in the 70s, but here mostly in the upper to mid 60s, and here lately it's more like 63, 64, and that's been an unusually tight low range. I have some of the influences along the way, which a lot of which include macroeconomic, external policy related or disease related things. You know, um, the COVID issue caused a depression or a recession in lots of markets. It did for cotton too, and then we pumped a bunch of money in the economy to get over COVID, and that stimulus money stimulated a lot of cotton consumption. Maybe there was pent up demand too, but that stimulus had an effect. We pulled that stimulus out of the economy and created inflation. That had an effect. A cotton related thing, the last major uh, disruption or stimulus, if you want to call it, that was cotton specific, was when China was in the market in 2023 buying up, like they imported 15 million bales and they used a lot of that foreign cotton to restock their government reserves. That had a major, that was the last time we had dollar cotton. And since then we've been on this slide. So a number of things going on, um, for different various reasons, and that'll kind of color my view of what may be coming when we get around to talking about especially the 26 season upcoming. So we've been in this area for a while. There's fundamental reasons to suggest why we should sort of be in a um, neutral market with supply and demand not really giving us a reason to bust out of it. These numbers here, the far right column, are the December supply and demand estimates for U.S. cotton. And for the last 2 months, since September, they've been bumping up their estimate of U.S. production. For the December report compared to November, they raised it I forget now but they raised it, and they raised it in this November report relative to the September. And that kind of has to do with the fact that we, for once, had decent weather during the 25 growing season. We had timely rains. We had relatively low abandonment. We had a relatively good crop condition through the year. We harvested dryland acreage in parts of Texas that previously we hadn't harvested dryland for 3 years, maybe. So it was a better year that contributed to higher yield, higher production, and better quality. So that's all good. It's just that the price has been so low that people are probably losing money on all these bales that were harvested. Demand is, of course, we export most of our U.S. cotton, and the export tally's been a little bit hard to keep track of because of during the shutdown they weren't reporting. We didn't have that as an indicator of demand because they weren't reporting for, I forget now how many weeks of the shutdown, and now they're playing catch up, issuing a couple of reports a week instead of just one. But it'll still be a what we're not caught up yet in terms of the data flow for a number of different things, including the U.S. export number. A lot of that depends on how the general economy goes, and we're not really clear about that picture. But the bottom line of all this is that we've got ending stocks projected for the 25 crop that are, in the ballpark of what they were the year before, a neutral year over year projection of ending stocks, which kind of gives us supply and demand reason for why we don't have prices busting out of to the upside out of the range that they've been stuck in for going on 2 years. It's just supply and demand is somewhat similar, so we expect the price range to be somewhat similar, and that's what we've got. There's other influences besides supply and demand, or maybe the way I would think about it is more like a catalyst. If you have a supply and demand reason to be flat, this buying and selling by speculators kind of reinforces that. We have a whole lot of short sellers in the market, shown by the downward green spikes in this chart over on the right-hand side. A whole lot of selling, kind of unusual. It's at historically large levels of selling. Now, having sold it, when these positions were implemented, that put downward selling. It put downward pressure on the market. But eventually all these positions are going to get lifted. So this, to me, kind of implies another reason for us to be flat, to be supported on the downside, because the market knows that a whole bunch of these short positions are going to get bought back at some point. If it all happened at once for some bullish reason and all these short speculators were to cover their positions and buy them back, the market could go up 5 cents if that was all to happen at the same time. But one way or the other, there's some buying implied by this scenario, and that's going to keep us supported on the downside. But it does explain kind of why we're sideways in the relatively low range that we're at. And just to wrap up thinking about next year, we always begin with some thoughts about how many acres we're going to plant. Thinking for economic reasons, when we think about the price of competing crops relative to the price of cotton, historically, that would put us in an area as indicated by this red arrow. I expect that given and this shows the price ratio of corn relative to cotton, given that historically, I would think that economics suggests we ought to be planting somewhere around 10 million acres, which is kind of where we planted. If you look at that little blue diamond that's labeled 25, that's how many acres we planted for the 25 crop. And that would have been a little bit higher, except that the delta got a whole bunch of early season moisture that prevented some of their planting. This year, I would expect, if Mother Nature lets us do it, I would expect acreage again planted 10 million, little over 10 million, and after that happens, it depends on the weather. We'll see what the milestone grower surveys that'll start flowing in early next year. We'll see what they say. Um, but like I say, my prior thought is that it would be somewhere in the realm of 10 million acres, and then it depends on Mother Nature. We're already in a dry situation. We have been all fall. Um, that'll have a bearing on things because we're starting off dry, and we're forecasted to have dry conditions based on the forecast of La Nina conditions, which are expected to continue through February at least. That's what this chart here is suggesting, is that there's better than even odds, 65% odds, 62% odds, 53% odds that we'll be in a La Nina winter, uh, getting below. Usually that's associated with dryness. So again, we'll have to see. But if dry conditions that continue through the winter, um, oftentimes that results in more than above average plantings of cotton in Oklahoma, Kansas, and particularly Texas. When it's drier than normal, we tend to plant more cotton and then see what happens. So we could have a response to this with more cotton being planted. And I'll end with this slide. That kind of sets us up, if it's a dry winter and that inspires more cotton, above average levels of cotton, more cotton planted than an economist would expect. Well, then when we get out of that La Nina condition, what happens if we have timely rains? What happens if Memorial Day we have rain, and rains once in June and rains once in July and rains once in August, and all that West Texas acreage unexpectedly germinates? Uh, we could end up with more planted and more harvested acres than anybody would expect if the weather was to unfold, is to shift from dry to normal, and particularly to get some timely rains next year the way that we did this year. That could result in, again, um, more supply and probably weaker prices. That would be if we got that switch, kind of a bait and switch situation, that would be the most bearish price scenario I could think of. Most bullish one would be if we planted less than what price ratios would expect, which is possible. Some people really focus on the experience they had last year, and maybe the low prices will entice people to do some alternative rather to cotton. And historically, the lowest we've ever got is 8.5 to 9 million acres, is about as low as we've gone in modern times. But if we were to do that and then be dry and then have high abandonment on a low planted acreage, that's probably the most bullish scenario, again, driven from the supply side. What I really think is going to happen is that we're going to plant somewhere in the neighborhood of 10, not a huge number, not a historically low number, and have above average abandonment, and that pencils out in a supply and demand sense, probably to ending stocks around 4 million bales, somewhat where we've been for what would have been for the previous 2 years, and somewhat of a neutral outcome, which, given this index of seasonal cotton prices, suggests that we might see 26 futures climbing. Right now they're mid 60s, a little lower than mid 60s. I can see them climbing to 70 cents. I could see them making a run at 75, maybe a little higher than 75, and peak. The historical price peak is usually in June. So the seasonal tendency is to have climbing prices during this period of uncertainty about the size of the crop. And then when we get some ideas about the size of the crop, that downshifts into the seasonal weakness. So this kind of just suggests to me we're going to rise into the 70s and then fall back down to where we are. That would be my forecast. And there's my contact information, and I'll hang around and answer any questions, Bob, but I'm going to stop sharing.
Dr. Robinson, we really appreciate you getting up and Adam and joining us for all these morning sessions. I know Bobby's been doing this a really long time with you guys, and I've enjoyed the opportunity to get to sit in and listen and learn along the way. We want to wish you you and your family a very Merry Christmas as we prepare to take some time away from maybe the office for a little bit and spend some time with family. So we thank you again for joining us. And I asked Bobby, I said, who do you want to go next? And he said, Welch. And I said, all right, well, we'll put Dr. Welch up next. Extension specialist for grain marketing. Glad to have you as well. Echo the same sentiments. Glad you're willing to get up and join us first thing in the morning. And we're going to talk a little bit about what these grain prices are looking like, what we can expect, and see if we've got the same volatility in the grain market that we just got Dr. Robinson to talk to us about when we think about supply and demand moving into the future.
Well, thank you very much. Great to be with you all this morning. And yeah, you're going to hear me talk about many of the same themes as we talk about the grain market that Dr. Robinson just shared when talking about cotton. Again, it's kind of remind us of kind of where we're trying to, these price determining factors that really, shape where these markets are headed. And one of the primary determinants of that for a marketing year is how much crop is left over at the end of the year from the previous year. That ending stocks number, and Dr. Robinson talked about that in terms of million bales of cotton. We're going to talk about that in terms of millions of bushels of grain and billions of bushels of grain in some cases, and the influence that has then on our overall price. Wrapping up the 2025 crop, I think we still have a lot of question around what the yield for this crop we just harvested is finally going to be. We'll talk about those specific numbers here in just a minute. But especially with the gap in the reporting from USDA in October and early November, I think we're still late. We're lagged in getting that data collected and reported. And I'm looking for the January crop production report to be a significant market mover in that we could see a significant change in that yield that's reported in January than where we're sitting right now. The other factor that's very positive in this current marketing year has been exports. Corn exports in particular have been on a very strong pace coming out of the last couple of years now and projected to be very, very strong in 2026 as well. Then, as Dr. Robinson was talking about on cotton, what about area and the influence that will have on our price outlook for 2026? And as he mentioned, a key factor in our flow chart of what that area number is going to be is returns from competing crops. He talked about the pricing relationship between cotton and corn. I'm going to illustrate the relationship between corn and soybeans, and then what that might do to shape that supply picture, and obviously then the price implications of a couple of different planting scenarios. And as he shared a kind of a long-term chart of price history, that's what the grain prices have done in Texas over the last 3 years. If you look at where we were 3 years ago about this time, we were just coming off of $9 wheat, $8 corn, $7 grain sorghum, and then we've been down on that trajectory since. One more favorable move in the market, despite this big fall that we've seen, is since August, early September, we have seen a little rebound in these prices. They firmed to some degree, and then we'll look at maybe some of the factors that might support. Is that an upward trend or trajectory going into the first part of 2026? What might be the staying power of that particular price movement? But at least things do look a moderate degree better here as we're closing out 2025 compared to where we were just a couple of months ago. And then back to that yield question. USDA's latest estimate for the U.S. corn crop is 186 bushels per acre. That's down from 188 something in August. They lowered that estimate then in September. We didn't get a report in October. November came in at 186, and they held that estimate the same in the December World Agricultural Supply and Demand estimates. The WASDE report last week held us at 186. The trend line yield, if you just look at yield growth since, and this chart shows since 1980, would project us about 183. And again, the reports I'm hearing is just like we saw in Texas. There's some really good corn crop across a large swath of Texas, but there were some pretty poor crops too. Again, a tremendous degree of variability in crop conditions and crop yields. And I'm hearing that all across the Midwest as well. And so as we nail down on what that final number is yeah, there's some really, really good corn out there, but there's some other places that are going to come in significantly lower than the crops of the last couple of years. So again, I don't think that question is settled yet. And that January report, I think is going to be very, very important. My bias, my projection, or I'm leaning toward they'll lower that number by the time we get to January, that 186 will not hold. Maybe, 184 would still be an outstanding crop, 185. But I think we're likely to see that yield number, again, with the variability that we're hearing across the country, likely to tick down by the time we get to January and certainly not go up again. Just what and Dr. Robinson mentioned, we're still trying to collect this data on corn export sales, or all of our commodity export sales. Corn is no exception. Reported as of November the 13th, however, and again, USDA has raised that projected to an all-time record high export sales for the year of 3.2 billion bushels. That's the third export sales record in a row for U.S. corn. Typically, by the end of December, we would have about 55% of that target on the books. As of mid-November, we're at 50% of that number. And again, we've got weeks of data here to add on, but on a very strong pace, well above the pace needed to hit that 3.2 billion bushels. And so that number is, I think, supported by the data we've seen thus far, and it may yet be, we revise that number even higher, given the rates of export sales that we're seeing here early in this marketing year. The normal customers, Mexico, Japan, Colombia, Korea, our CAFTA partners here in the Western Hemisphere, the main buyers of U.S. corn. So looking at the spreadsheet, if you look at the balance sheet, as we went from the 2024 crop, here we were in November, here we go to December. That change is from the November to the December WASDE report. No change on the supply numbers. Left acres the same, left yield the same, no changes whatsoever. Still looking at an 18.3 billion bushel corn crop, blowing, we'd never seen 17 billion bushels before. So this is, blowing the top off the previous records in terms of corn supplies. And the only change they made on the use category, there's that bump up in exports up to a 3.2 billion bushels. That lowered our use number, increased our use number, lowered the ending stocks. So we've got ending stocks drop from coming from a very low 1.3 billion bushels in 2024 up to 2.1 billion and back down to about a 2 billion bushel carryover. And that lowers that carryover to use, that stocks to use ratio. The number I use is days of use on hand at the end of the marketing year. We're dropping from a 48.7 day supply of corn to a 45.5 day supply. That would typically be an upward movement on price, but given so much grain has already been sold, I think at this point, by the time we got into December, USDA left their price projection unchanged at $4 a bushel. And what that looks like on a longer term relationship, when we have that pile of grain getting bigger, the days of use on hand on the increase, that tends to put our downward pressure on prices. And of course, the inverse being true, if we see that pile of grain getting smaller, days of use on hand declining, that's when we see our much better pricing opportunities. With 40 being a real threshold in the corn market, when we've seen $5 corn and better, it's been when we generally see that carryover below a 40-day carryover in the grain market. When we get on the upper side of 40, that's when we see that more of a depressed price relationship. and a price response when we look at our corn market. So the latest assessment from USDA about this 45-day carryover and about a $4 U.S. average corn price. And what the corn futures have pretty well followed their seasonal pattern through the 2025 crop year, with two primary differences. One is that we hit the high in February instead of June. That was very unusual. But since that time, the price drop toward fall as the crop was big and it was good. You would expect that to be a negative impact on price, pushes pricing lower, and it did, with the difference being we actually hit the seasonal low back in August instead of September or the first part of October. So we hit the high early, we hit the low early, but then the price response since then, kind of the post-harvest rally, you might call it, as the December contract goes off the board, is we rallied that market about 40 cents. Well, that's kind of what the market normally does in this kind of perspective, is coming off that harvest low. And so we're poised at kind of a normal position of a little bit of a moderate trend upward in grain prices as we're closing out the year, and setting us on a path perhaps that normally in January, February, or March, that's a time frame when we would continue that trend of upward price movement into the first part of the year. So again, we're closing out a year of, even though it didn't line up exactly, certainly following the overall general seasonal patterns in the corn market. Another overarching factor in corn is global corn production. All-time record high production of our foreign ag producers, all-time record high in the U.S., blowing through 50 billion bushels of corn production. We set a record this year, and we set it by a lot. Significantly step higher when it looks at global corn production. And where did that come from? Primarily the U.S., but every single major producing area had a bigger crop in 25 compared to 24, except the European Union. They were down about 100 million bushels, but otherwise bigger crops in every other major producing area, which is primarily dominated by the big three, the U.S., China, and Brazil. But it's interesting to note that even with that record corn production, again, we went over 50 billion bushels for the first time, never seen this much corn produced in the world. The global stocks to use ratio went down. Production, even though we made over 50 billion bushels, is not keeping up with the pace of corn consumption. That we're seeing that relationship continue to get tighter and tighter and tighter. It's been on a tighter trend since 2016. And we've seen, of course, the U.S. numbers and dominates much of the global corn market over that 40-day carryover in corn back in 15, 16, 17, 18. But then we see better pricing opportunities drop below that 40-day carryover, 20, 21, 22, first part of 23. And now that we're bouncing back in 25, that's, I think, creating some cushion in the market. But globally, I think this just positions us to the case that even that we've got to keep this pace of corn production, or that global situation is going to get tight. Right now, we're the tightest since we've been since 2012. And if we have a major production or supply disruption in any of those major producing areas we were just looking at, I think we are setting the stage for a significant price response, a volatility in the corn market, of just a threat of that corn supply changing in one of these major producing areas. So I think that's kind of a running in the background as we're looking at, somewhat of a moderate, at least upward trend in the grain prices right now. How about acres then for next year? I'm using budgets from the University of Illinois, and using their budget spreadsheets, the price of corn and soybeans, the relative prices at which the returns from each of those crops would be about the same, is about 2.3. Take the soybean price, divide it by the corn price, and if that relationship is 2.3 on a futures price basis, that would, the returns from planting corn and the returns from planting soybeans, given their yield and cost inputs, would be about the same. That relationship as of yesterday was running at 2.35. We were looking at a futures price on corn of 459.5. Soybeans on the November contract were trading at 1088.25. Using a 30-cent basis for those farmers in central Illinois, that would give them a cash price for that 2026 crop, $4.30 a bushel on corn, $10.58 a bushel on soybeans. Using their cost estimates, that would corn farmers would lose $100 an acre, and their soybean farmers would lose about $20 an acre. So if you're making your planning decisions for 2026 and you're sitting down with your team and talking to your banker, what are you going to do? The economics would point that this would be the year we'll shift some acres back from corn into soybeans. Excuse me, they're going to shift them anyway. Just last year we increased corn acres by 6 million acres, and just on a 50-50 split, most farmers are going to take those corn acres and plant soybeans. They're going to take their soybean acres and going to plant corn. So there's going to be a lot of that just back and forth, no matter what prices are doing. It just makes sense agronomically, and that's just their farming system. But on the margins, will it attract more acres? Maybe again in the cotton world, if we see a rally in the corn market, would we draw acres there or lose acres? Conversely, if it's dry. So those are the kind of factors that might influence from an economic standpoint. But I think at this point, it would support the idea that in 2026, we are going to see fewer corn acres than we did in 2025. And this is just one demonstration of a key part of the corn growing area in the U.S. of why that might play out. Because even though the soybean price is not great, it's looked like a $70 advantage of planting soybeans over corn at this time. So put together a balance sheet for 2026 based on that kind of information. And this is usually numbers from the FAPRI organization at the University of Missouri. Their projected corn acres for 2026 are 92.8. They're looking at 5 million fewer acres of corn next year than we planted last year. So if we drop acres by 5 million and we drop yield back to a normal kind of yield, which would be around that 183 bushels, we're going from a 16.7 billion bushel corn crop last year to 15.5. 1.2 billion bushel fewer production, lower supply. We got larger carryover. Supply goes down around 800 million bushels. They're looking at lower domestic use and slightly lower exports next year for the corn market. So they're looking at somewhat of a lower use estimates as well. But their ending stocks would drop from with those planted numbers and these use estimates, we go from ending stocks of 2 billion bushels to 1.77. That takes the carryover from a 45-point day carryover to a 41. We're crowding back over to that. We're not below 40, but it's getting closer. And an average farm price from a $4 this year, perhaps up to a $4.30 price for 2026. And you can see how that kind of crowds us back up to that 40-day line, creates some more pricing opportunities, some pricing volatility. If we see that lower planted acre number start to come into the expectations of traders in this market, I think that puts us on that positive trajectory of prices between now until we get into those key planting dates that Dr. Robinson was talking about, into February, March, June. That's what drives much of that upward price momentum at that time of year. On the other hand, let's say we don't cut those acres by 5 million. What if we cut them by 3? Now, we still plant more soybeans next year than corn than we did the year before, plant less corn than we did the year before, but only by 3 million acres, not 5 million. What kind of price impact did that have? Well, now we're looking at production of a 15.8 billion bushel crop, only down about 900,000 bushels from the year before. Supply is down, but not down 700,000 or 800,000 bushels, down 400,000. Carryover, 45.5 days in the 25 crop, goes up to a 48.7 day carryover. That puts downward, well, ending stocks stay about the same, 2 billion bushels to 2.1. We look at an average farm price going down with just that 2 million acres. Instead of a 5 million acre cut, a 3 million acre cut, we go from a 430 price to 375, and that price projection for 2026 that slides way over here to the right. So that's just important, that one key element and trader and market expectations around just that planted acre number. And that can shift our price outlook significantly when it comes to 2026 expectations. But my thought at this point is that we will see, first of all, lower carryover from last year. That yield number is not settled. So if we drop the supply of corn, I think that gives us upward price movement as we close out this year. And then if on that acre number, if we're looking the difference between a 95 million acres, 92 million acres, I think watch developments that may indicate what farmers are planning to do for 2026. I think that could give us some significant price support as we close out this year, and we could use it. That's the December contract for 2026. We bump up there to 475 a couple of times. Again, if we have a lot of acres, weak demand, we could see that futures price way back in the low fours. Again, we cut those acres, keep our use numbers up, trading that futures in that 450 to 475. I think that looks like a strong possibility with maybe some better opportunities into the spring. I think those are the factors that'll shape that price direction as we wrap up the rest of this year. How big was last year's crop, and then how many acres we're going to plant for 2026. So appreciate the time to be here today. Again, I'm costs are high, margins are tight, but the world grain balance sheet is tight too. And so I think that gives us some underlying support. If we get some of this trade confusion and chaos settled, I think that will give us a little more clarity for moving these markets forward and moving them higher. Because I think the global situation would indicate that the world needs our grain. So appreciate being with y'all this morning. I'll stop sharing my screen if I can find the button. And any questions or comments, I'll take those and I'll hang around to see kind of what shared the rest of the program.
Hey, Mark, can I ask a question?
Yeah, you bet.
So on those corn exports, you got to, Mexico's a pretty big share. Are we seeing any growth in exports to Mexico, maybe driven by that they got more cattle to feed because they didn't come here?
And that's, yeah, we talked about before we got on the air here today. And one of the estimates we're seeing from FAPRI is that domestic feed use may go down for corn next year, but exports staying strong. And it is what you're saying. If we're not importing those cattle to feed them here, might we export grain to feed them somewhere else?
Right.
And one thing, it's not really showing up in the data on corn at this point because Mexico's such a large buyer anyway. So they are our number one customer. So we're kind of running those numbers. What we are seeing is that from late the previous marketing year, back in July and August of last year, and then carrying forward so far this year in the data, they're importing grain sorghum. Yeah. Of course, we've shut off the boats going to China at this point. And so there's a lot of cheap grain sorghum along the coast and in South Texas. And is that where our sorghum is going, or are they feeding the sorghum? And so I think we are seeing a more positive grain flows in general going to Mexico. Hard to pick out on corn because they're so big anyway. But if you look at grain sorghum, that's a shift in the market. And so there does seem to be something going on there. And that makes a lot of sense to me. That
makes sense.
If the cattle aren't coming here, they got to feed them somewhere. If they've got the capacity to handle them, and you can tell us more about that. But that seems to make sense.
Hey, thanks.
Yeah.
Dr. Anderson, you did a fantastic job on the segue from Dr. Welch's presentation into yours. You obviously, you three have been quite the trio for a number of years. Have this absolutely down to science for a play on words there. But Dr. Anderson, I think you might, for some of us, have some of the best news of the day. And as we think about closing out a year of economic conversations and programming from our side of the desk with you guys, sentiments again, thank you to Dr. Welch and Dr. Robinson for always being available when we call. You guys have been what I would call county agent specialists since the beginning. And Dr. Anderson, you stand right there with that trio and have always been supportive of county programming and truly getting down to help the producers and being a part of those conversations that are so important as they navigate their role in providing and producing the safest, most wholesome food supply in the world. And a lot of that, I tell farmers all the time, they have more faith than anybody I've ever met. They have to. They operate a lot on it, but some of their faith is got a foundation in what do the numbers say. And we appreciate you guys bringing that to us. Dr. Anderson, we'll turn it over to you and let you talk to us about what the livestock market looks like.
Well, great. Thanks, Kara. Can you see my screen?
Yes, sir, we sure can.
All right. So, gosh, let's jump into the cattle market here. We got a lot of interesting things happening, and we have had certainly for a bunch of months now. But, I titled this one kind of Growing Beef Production. I think that's one of the really interesting things that may surprise us right now in the marketplace is that we are actually producing a little more beef than we did a year ago at this time. So we might think about this supply relationship going forward and how it's affecting prices. So I want to start with kind of 3 points I want to bring home. One is that we're increasing beef production and total red meat. The second point is, cattle prices are rebounding from all the turmoil that really kicked off in October. And a little bit on the trade side of things, because I think that's important as well. So my slides are going to address these three, then we'll come back to these three towards the end. But, let's start with fed cattle prices. Certainly in sort of mid-October, lots of social media, political jawboning about cattle prices and beef prices being too high. And that really kicked off a pretty big slide. Now, we went from about 240 in the cash fed cattle Southern Plains market to about 220. But we saw a much larger decline in the futures market. And what I would highlight is that we've seen a pretty strong rebound up to about 230 in the Southern Plains market. Not back to the 240 that we had, but really pretty strong prices and kind of moving in at least in a positive direction. So, I think it's important to recognize that we've got this rebound going on for all the changes in the futures market. Fundamentally, not much has changed. Tight supplies, good demand, and certainly cattle prices reflecting that. We might think about this lead, as we finish up the year and we lead into next year. My expectation is we're going to have higher prices in 26 than 25. Particularly that first half of the year, as we roll into January, February, March, April, we've got prices a good $30 over where we were at the beginning of last year. So certainly, I think we'll see higher prices next year than this year. That might, we might narrow that gap or so when we get later in the year. But still, I think the supply situation will argue for eclipsing those prices that we had in 2025. So again, I think this rebound is important, that fundamentals kind of take over here with tight supplies and good demand, and we move prices a little higher. So I also want to highlight the cutout. And the cutout is sort of, I think, a great picture of just plain a roller coaster in markets. The ups and downs that we see normally driven by spot purchases, particularly driven by, think about 4th of July, Labor Day, into grilling season, things like that. But, while we had that slide in the fed cattle market, we've had some rebound in fed cattle too, but we got the cutout wholesale market declining. And I think we can really trace some of that to just simply the turnover from grilling season needs to winter beef consumption, different cuts, things like that, but also the supply side of what's going on. So let's keep those price charts in mind. And I want to start with steer slaughter. There's some stuff that I think we ought to recognize is that typically, if we look back at this 5-year average, that red line, the number of steers going to market tends to peak in mid-year, then slides off as we go into the fall. And this year is, much the same. I think a bit muted, but still that general idea holds. But you might look as we got in the last several weeks, we've actually got beef, the number of steers going market closer to a year ago than we did earlier in the year. And what that means is our difference to a year ago is smaller. And I think that's important in terms of where we are in terms of beef production. So let's keep this in mind that maybe we're narrowing that gap in terms of number going to market to a year ago. And we have hit new record highs in dressed weights. So I want to tie this back to certainly to Mark's corn market stuff with these. I mean, my gosh, with low price corn, certainly the incentive is to put more weight on them. So we're making up for fewer numbers going to market through heavier weights. So just look at the magnitude of these weights. Over 980 pounds dressed weight. If you got a calculator handy, divide that by 0.635, sort of divide. I mean, if we divide that by 0.635, which is a rough estimate of yield, that'll get us to a live weight. Well over 1,500 pounds is an average live steer weight going to market. Certainly record high dressed weights. I mean, last year we hit 960 pounds in the fall and everybody was amazed. Now we're hitting over 980 pounds and we're still amazed. And that's just a huge amount more pounds. So we take those steers that were narrowing that gap to a year ago and we add another almost 30 pounds per head compared to a year ago. And we get beef production in the last couple of weeks higher than it was a year ago. So, we got more pounds on the market for sale today than last year at this time. That slide down lower in the wholesale market, I think we can explain that right away here with just some more supplies. Now countering that kind of seasonal pattern of the steer slaughter side, if we look at beef production tends to be its lowest over there in the spring, and we build beef production in the fall. Some of that is from cull cows. Beef cow slaughter tends to peak in the fall. That's happening again this year, but it's still at lower levels than last year. Dairy cow slaughter is running a little ahead of a year ago, and simply because we've got the most dairy cows in the U.S. since the early 1990s, and so more dairy cows is fueling a little more dairy cow culling, a little more dairy cow slaughter. But here we are producing more beef, which what that implies is we've got more fed beef on the market than we did last year. So that change in the wholesale market, I think we ought to consider in the context of more beef today than a year ago. That is likely a big surprise for folks because we know we got a smaller cattle herd, we got fewer cattle on feed, just tightening up supplies. Yet as we talk about tightening supplies in that longer term, we've got this fluctuation where we actually got more than we did last year. I think that's a surprise to people, and I think this rising beef production really since October plays a role in falling prices. So we ought to consider that supply side component a real fundamental supply side component in increasing beef production, not just I think, we might talk about the, social media and political statements and those kinds of things is kind of popping the bubble, and certainly in the futures market, giving those traders a reason to sell. But here we got some supply side kind of supporting those that notion of lower prices as well. Now, I get this comment sometimes from folks about overall meat supplies and what's going on. I want to highlight too, we look since October, we've got rising production of red meat. Red meat's going to include beef, pork, and lamb. We've got a rising amount seasonally. It tends to go up. Really, our pork production is increasing over a year ago. Beef production just showed you the last couple of weeks. We got a little more beef production than a year ago. We got a little less lamb production, but that gives us total red meat supplies over the last couple of weeks greater than last year. So even though in this broader context of beef, we've actually figured out how to produce more red meat than we did last year. And somebody will ask, if we just talk red meat, they're going to say, well, what about all meat? Because we eat more chicken than anything else in terms of per capita consumption. What's happening there? And I stuck on here broiler production, kind of, federally inspected broilers. And we've got more of that than we did last year as well. And so, if we put this in terms of total meat supplies, red meat and chicken, we got more meat on our market over the last couple of weeks than we did a year ago. I think that might surprise a lot of us, but certainly look over throughout this year. just about every week this year, we've had more broiler production than last year. So certainly, and you know, we've had some profitable chicken prices. We've also had lower feed costs, as Mark talked about. So, you know, those are a recipe for some profits and some expansion, particularly on the broiler side that can respond very quickly. So in the calf market, that same rebound we've seen on the fed cattle side, we've seen a rebound in the 500 to 600 pound number one steers, Southern Plains. We're back over 450. We're back where we were kind of at the peak. So the big scare sell off in the futures, which again did not happen as much in the cash market as it did in the futures side. But we've got some rebound in these prices. I tell you what, you know, I think we head into next year with higher prices next year than this year. I think this rebound is particularly important if you got stocker cattle and you bought those back in September, really at the peak of the market. You set through this crash that went on. I think we do have on that stocker side. I think time helps us. Time lets us get back to some fundamentals and the recognition that we've got really tight supplies and this is going on here. I think that gives us some hope that maybe we didn't have back sort of at the end of October, early November with lower prices and really erasing the profit margin that a lot of our stocker guys would have had. I think this rebound gives us some hope that we can the time's on our side to kind of rebound those spreads a little bit, rebound that margin. And give us get back to some chance to some profits on that side. I want to say something about trade. You know, normally our trade data on the meat side is delayed about 2 months. We picked up another month of data. And I'd like to highlight that really our beef and veal imports, we actually declined again when the August data came out. We actually got a little bit below a year ago. So if we're thinking about the trade side of things, certainly I think this reflects that additional 50% tariff that was on Brazil that has been done away with more recently. We'll see what happens as we get that data later in the year, but certainly I think that's had an effect on our imports. So actually we got a little bit below a year ago. You know, if you're concerned about imports, pressure and prices, the biggest effect would be in our ground beef market, lean beef trimmings that's the majority of our imports. And so we did import a little less. This dark line, sort of black looking line, that's our imports from Brazil. And I would highlight the last couple of months, imports were declining, but we took another big decline, got under 50 million pounds in August. And that made Brazil actually our fourth largest source of imported beef. Australia is the red line. Canada is that kind of medium blue, royal blue line. Mexico is the green line. We actually imported more beef from Mexico in August than we did from Brazil. And Brazil was down there right around the amount we got from New Zealand. So, you know, prices, in this case, a really high tariff. Relative prices have really mattered in these import markets, and that's reduced the amount of imports from Brazil. On the export side, our exports continue to decline. The biggest decline in our exports is really coming from China between tariffs and retaliatory tariffs and them deciding, you know, they're just going to buy a lot less from us through their approval process for plants to export. We're shipping less beef, you know, and our record high prices do impact this trade market. It's not just China. The one market we have seen some increase in is South Korea, but a little lower exports to some other places as well. But again, overall lower exports, which is exactly what we would expect with record high prices. So the overall level of imports are higher. We've seen some decline, some seasonally, but also related to tariffs, but this decline here in exports. So by volume, we are importing more beef than we are exporting. But in the biggest sense, that's a function of relative prices and where we are in our cattle and beef production and prices. So I think that's my last slide, except for I want to go back to those 3 points and just reinforce this idea that lately we've got some increasing beef production and total red meat supplies on our market. I think that has something to do with prices. Our cattle prices have rebounded from those lows and kind of that volatility. And again, we got some interesting stuff happening on the trade side, and that's really my last slide. Again, we'll get into a new year where I think certainly from a supply standpoint, we're headed for tighter supplies overall, and I think that really will relate to some better prices next year than this year. And that's my last slide, so I'm going to end the show. Maybe I can stop sharing. And anybody got any questions for me?
Yeah, David, this is Mark. Did you say those cattle going to the packer over 1,500 pounds?
Yeah. So I'm gonna reach over here and get my calculator, and
Good
I'm gonna
night.
use 980 pound dressed weight divided by
Yeah.
0.635 as a yield. That gives me an average fed steer weight of 1543.
40. Good God.
You
And
know,
oh
it
my
wasn't that long ago that 980 pounds or 960 pounds was a live weight. And
right.
now that's our dressed weights.
Right. That's what I was thinking. Good night.
It's
Now,
kind of hard
is that?
to wrap your mind around 980 pound
Oh
dressed
my.
weights.
Are they getting more meat on a carcass now? You said that 63.5% or whatever the carryout or turnout was. Is that getting better and better too? I mean, are they getting more production off a carcass with, I don't know, techniques or cuts
Yeah,
or?
generally, I think long term, we can think of these yields improving, that the yield
Mhm.
has gone up. It's certainly true now with these kinds of weights. There's more fat on those carcasses. We do have an increase in yield grade 4s and 5s, which just implies more fat.
Yeah.
And so, maybe it's a good thing we've got this trend towards using beef tallow for cooking fries. There's as it was pointed out to me by a young colleague, obviously, who had seen on TikTok, some influencer was using beef tallow as her skincare routine.
Oh, well, there you
So,
go.
maybe that
Yeah.
adds a little value, and it's a good thing we got all this fat right now. I do think that, this increased amount of fat, beef tallow, the trend in using beef tallow for frying stuff, things, but also renewable fuels
Mhm.
for the inedible tallow. There's an interesting trade component to that. And one is we got this fat, and that's typically a pretty low value product. But if I can get a bunch of lean trimmings to add to that, now I've got ground beef I can sell at a much higher value.
There
I
you
think
go.
that ought to make us think a little bit about trade in terms of, that these imports that we're getting of lean beef allow us to turn some more of that fat into a higher valued hamburger product. And so, really in that regard, we can think of imports as actually increasing the value of the beef we're producing, which
Yeah.
is a different way to think about it. Yet I think on the margin, that's probably pretty important in terms of these weights and the fat we're producing.
Yeah. Yeah. Interesting.
It is interesting. And I mean, go to the grocery store and look at the bin where all the briskets are and see if you can find a 15 pounder. They're all going to be about 22 pounds. Seems like.
Right. Right.
You may be cooking for days.
There you go. But that's okay with me. Bigger the better.
I like barbecue.
There you go.
Dr. Anderson, thank you for that. I'm going to share a comment I saw on a friend's social media the other day where, for those of us in South Texas watching some of the plants and processors down that way, you're not wrong, Dr. Anderson. Comments are they're seeing over 1,000-pound carcasses daily. And again, that's carcass. That's not live weight. And, Dr. Welsh asked a good question. What does that translate to in some of the sizes? And talking 16, 17-inch ribeyes.
Mm-hmm.
I don't know who can afford to buy one of those at the restaurants. It's not this county agent. But yeah, it's incredible. Good or bad, I don't know. I guess time will tell us, right?
Yep.
It's interesting. It's what a time to be alive, I guess, right? It's the conversation. Uh, Bobby looks like he's about to have a question. He always has a question.
Oh no, I'm just enjoying the conversation.
All right.
Oh, I've got questions, but we don't have time to answer them.
Bobby, you got to pay a consulting fee for some of that.
What's that?
I'm pretty cheap.
You do get what you pay for.
That's right.
Gentlemen, it's been a pleasure. Dr. Anderson, I'll wish you a Merry Christmas as well.
Merry Christmas.
Bobby, thanks again for helping be the mastermind and the lead on this. You do a fantastic job. We're glad to get to keep doing this. Looking forward to what appears to be some potential for bright spots in 26. So it'll be interesting to see how the markets close out the year and what estimates look like for acreage next year. You know, we all know it's going to take us a while to rebuild the cow herd. That's not going to happen overnight. And maintaining those big cows that are making those fat steers, that's going to be a challenge if we look at that weather pattern that Dr. Robinson so eloquently shared with us first thing this morning. I will admit that was kind of a low point when we think about what that looks like. But that's okay. We'll forgive him for that today, I guess.
That's my job.
Well, again, thank y'all and Merry Christmas to everybody. And need something from our direction, please give us a call.
Thanks. Merry Christmas.
Thank you, gentlemen.
Great to be with y'all. Merry Christmas.
Guess we'll sign it off.
Thanks,
Have
Bobby.
a good day.
You too.